Hello and welcome back to the Chart Pattern Trading Masterclass by Wealthy Education. In this video, we begin Module 3, the most bearish chart patterns. This particular video is about the double top pattern. So if you remember, there was the double bottom pattern being a very bullish pattern. This is the exact opposite. It's basically an area on the chart that markets won't go above. So instead of a W pattern, this is called an M pattern by some people. It can happen on any time frame, and basically it just tells you that, hey, the market doesn't want to go up here. Now, granted, nothing's 100%, but as a general rule, once you break down below the bottom of the letter here, that's when you short it, and you should be looking for basically the same height as the pattern. So let's go ahead and take a look at a couple of examples. This will be really easy because you already have a general idea as to how this plays out due to the double bottom video. But notice here, we have a peak, and here we have a peak. So what does this say? This says that the market does not want to go above here. So it's a bearish signal. You would look at this through the prism of this M pattern here. And now that we have broken below it, you're looking for that type of move, that height of a move. So in this case, it's about $40. So 380 would be your target. And that's essentially where we stopped at the conclusion of that move. You put your stop loss on the other side, or, you know, you can use other things. So let's take a look at the structure of the M pattern itself. Like right here, where we saw a big impulsive move lower, you could save yourself a little bit of risk. It's $10 lower here in the spiders. This is the SPY. This is the ETF that tracks the S&P 500 total. So you can see that the market has, certainly taken off to the downside at that point, and therefore, momentum really starts to work in your favor. So with that being said, pretty straightforward trade. So this obviously, like I said, happens on all time frames. As a general rule, with any technical analysis pattern, and this is no different than any other one. As a general rule, you have more faith in a higher time frame one. But again, like I said, they do occur in shorter time frames. So let me go ahead and go to, I don't know, like a 30-minute chart. So here in dollar Canada, you can see very similar situation to the one we just saw. We saw a bounce, a rise, a pullback, and a rise. Now, these are, this is like 15 pips, 10, 15 pips of differential. Remember, in the W pattern or the double bottom, I said they don't have to be pip to pip or tick to tick or penny to penny, depending on the market. You want them somewhat close. This is probably close enough. There is a little artistry involved, and there's a double bottom, so it's the exact opposite. You could make an argument for this being a double top. You could kind of make an argument for that being a double top. Here's a big one. That's another thing too that a lot of people don't think about, but it's the time spent making the double bottom that sometimes makes it more interesting as well. So, the double top and then double bottom kind of functionality of this. So what does this tell you? This tells you, this is a little bit more complex. So this tells you there's a lot of consolidation, because interestingly enough, when you look at this, you can look at this and say, okay, well, it's a double top, right? But you can also call it a double bottom in the middle. So is this a big W pattern? If it is, then isn't it bullish? Well, we didn't break out on top of it, right? We did break down below the bottom of it. So you can look at it through the prism of almost like a complex consolidation area. So this is very noisy, but you can make an extreme argument for a huge double top. When you break through this, you have to think that everybody between 132 and 131 now are losing money. It's one handle, 100 pips, and clearly you got that. So a little bit of a complex example I wanted to show you. You can also look at, you can also do this. You know, you could have said, okay, well, that's a double top. That's a little cleaner, a little easier to see. So it just kind of comes down to how in the weeds you want to get. My personal opinion is you want to see something that is very obvious. So here's one in Chili's. There's a nice double top. And what do we like about it? Well, we like the fact that the moving average is crossed right afterwards. But what else we like about it is that it's right at the 30 cents level. Let me go ahead and get rid of these drawings. Let's add an indicator or two. So let's see. Let's do the MACD. You can see that we crossed over here right at the other side of this double top. So that's a good sign that perhaps it's time to start selling again. Let's head back over to the stock market and let's see Microsoft. Okay, so let's go ahead and move up to the. This is another example of, like I showed in the dollar Canadian dollar, you can say, hey, we just made a double top. You can even say we made a triple top, which is the same thing, but three. You can say it's a complex pattern. You could even say, let me get rid of all of these. You can even say that, hey, this was a double bottom, but it didn't break to the upside, just like the other one didn't. So really, what are you looking at when you see this? You're looking at a double top. You could just call this the double top. Triple top, you counted this one, 1, 2, 3, a double top and a double bottom. Or you could just call this consolidation and could even make a rectangle out of that. Now, here's the thing. You don't want to get too far into the weeds with this. What you want to do is you want to understand what the market's trying to tell you. And what it's trying to tell you is there's a big fight between 320 and I'll call it 345 here in Microsoft. Well, once 320 gives way, you have confirmation of at least a double top and a break of this double bottom. Remember, I said early in this course that a failed pattern says something too. This little double bottom here failed. That means everybody who bought in here suddenly is very fearful. Remember, there's psychology involved. So on this double top, that's what you want to call it. And like I said, it really doesn't matter. It drops right down to the 200-day EMA as a measured move. I don't want to confuse you with this. I want you to think about what the patterns are trying to say to you. A lot of courses get far too technically driven and they don't make you kind of think about, sometimes the market screams, sometimes it whispers. In this area, it was whispering because it was kind of telling you, okay, so what's going on? Well, certainly looks like there is some push and pull. You can do like an RSI. This may have been the tell right here. The RSI was in overbought condition. And then we started to drift lower while the market went sideways. So just something to think about. But double top patterns are great patterns. Same reason double bottom patterns are. Everybody sees them. And in these complex ones, if you know how to read them, you can really clean up because that's something that people don't see until later. They typically will stick to this double bottom here, something that's really obvious. And that's fine. There's nothing wrong with it. It just comes down to how conservative you are with your analysis. I just want to impress upon you that there's a certain amount of artistry in it as well. With that being said, we will go into the head and shoulders pattern in the next video.